this lecture, we will be discussing prop firms, funded accounts, and the key differences between Apex and Topstep. Proprietary trading firms, commonly known as prop firms, are companies that provide skilled traders with the opportunity to trade the firm's capital rather than their own. In exchange, the firm takes a percentage of the profits generated. This model allows traders to scale up quickly without risking large sums of their own money, while the firm benefits from leveraging the trader's skills to grow its assets. Prop firms exist to capture market opportunities through talented traders. Since many independent traders lack significant capital, prop firms offer a partnership where traders can access larger trading accounts than they could fund on their own. Funded accounts are trading accounts that prop firms provide to traders who have successfully passed an evaluation process. This process typically involves several stages designed to assess a trader's risk management, consistency, and profitability. The evaluation generally includes starting on a demo or simulated account and must meet specific profit targets without breaching defined risk limits. Traders are required to follow strict rules regarding maximum daily drawdowns, overall loss limits, and position sizing. Evaluations often come with a minimum number of trading days to ensure consistency, and traders must achieve the targets within a certain period. If the trader meets these objectives, then they are offered a funded account. Once funded, traders begin trading real capital provided by the prop firm. Depending on the firm, the profit-sharing structure may vary, with the trader keeping anywhere from 50% to 90% of the profits. However, they must continue to follow the firm's risk parameters or risk losing their funded status. Two popular firms in the industry are Apex and Topstep. While both firms offer similar services, there are distinct differences in their evaluations, funded accounts, and overall offerings. Apex trader funding offers more flexibility in the evaluation process, and traders can often choose from various account sizes and types. Topstep has a more rigorous and structured evaluation process, focusing on building consistent habits. They require traders to follow tighter risk management and drawdown rules, which can sometimes feel restrictive, but aim to build long-term success. We will be delving into the key differences between the two prop firms on the next slide. At evaluation stage, Apex tends to be slightly more flexible and a single-phase approach. Topstep is a two-step evaluation with stricter rules. In terms of profit split, Apex lets you keep 100% of the first $25,000 and 90% thereafter. Topstep is 100% of the first $10,000 and 90% thereafter. In terms of risk rules, they both have profit targets. They both have max loss limits. However, Apex has a trailing drawdown, which I'll come to discuss in a consequent slide, and Topstep has a daily loss limit. In addition to this, Topstep has an extra risk rule, which is the consistency target, the 50% rule, which means that your best day cannot be more than 50% of your total profits. In terms of fees, Apex tends to be lower with frequent discounts, and Topsteps tend to be slightly higher, but they include education and support. In terms of scaling your account, Apex provides more rapid scaling possibilities, whilst Topstep is a more gradual scaling approach. In the next slide, I'm going to be covering what the trailing drawdown is, illustrated via some scenarios. The best way to understand Apex's trailing drawdown is by going through some scenarios. In this table, we highlight three different examples. So the first example is profit growth and drawdown. So let's say you start with a $50,000 account. Your initial trailing drawdown is $47,500 because this is $50,000, your starting balance, minus $2,500, which is your trailing drawdown. Now let's say you take one trade and you go $1,000 in profit. Your account balance is now $51,000. Your trailing drawdown now moves to $48,500. It's $51,000 minus $2,500. You take a further trade. You make $1,500 more. So your account balance now sits at $52,500. Your trailing drawdown now moves to $50,000 because it's $52,000, your new balance, $52,500 minus 2,500. Let's say your next trade is a $1,500 loss, which puts your account balance at 51,000. So your trailing drawdown stays the same. It doesn't move. It stays at 50,000. Let's say at this point you take another $1,000 loss, which puts your account at $50,000. At this point, your account is closed because it's hit its $50,000 trailing drawdown. Example 2 will illustrate what it looks like with losses. So again, a starting balance of 50,500, your initial trailing drawdown sits at 47,500, which is 50,000 minus 2,500 of drawdown. Let's say you take a $2,000 loss. Your account balance is now 48,000, but your trailing drawdown stays at 47,500 because there's been no new profit high. Let's say you take a further loss of $500. Your account balance is now 47,500 and your trailing drawdown is 47,500, which means at this point, your account hits drawdown and your account gets closed. The important thing to understand with trailing drawdown in Apex is that it's based on unrealized profits. And example 3 will help illustrate what this means. So again, take a starting balance of 50,000. Your initial trailing drawdown is 47,500, which is 50,000 minus 2,500. Now let's say you take a trade and you're up net positive $2,000, but you don't realize these profits. You let the trade come back to you and you get out of the trade at break even. Your account balance will be at 50,000 because you haven't taken a loss on the account. However, your trailing drawdown will move to 49,500 because it's 52,000, which was the highest unrealized profit on your account minus the trailing drawdown, 2,500. So it's important to note that this trailing drawdown is based on unrealized profits. What happens if you fail an evaluation or a funded account? If you fail an evaluation or a combine, you can reset these for a fee. If you fail your funded account, you will need to start over with a new evaluation and restart the process of getting funded again. Let's discuss two comparable $50,000 accounts between Topstep and Apex. So at evaluation phase, Apex is a two-step evaluation based on profit target and the 50% consistency rule. Apex is a single-step evaluation just based on profit target. They both have a profit target of $3,000 and Topstep has a max daily loss of $1,000. However, Apex doesn't have a max daily loss. They only have the overall trailing drawdown. The trailing drawdown for Topstep is $2,000 and for Apex, $2,500. Currently, the Topstep evaluation fee is $49 and Apex is $167. However, often heavily discounted and are currently at 80% for $33.40. The reset fee for Topstep is $49 and for Apex, $80. Again, often discounted and is currently at $35. Once your evaluation process has been passed, to activate your funded account, Topstep has a fee of $149 and it's a one-time, one-off fee. And Apex has two options, either $105 a month or $160 for lifetime. Again, often heavily discounted and is currently at $85 for lifetime. In terms of how many contracts you can trade, Topstep allows you to trade 5 contracts and Apex allows you to take 10 contracts. In terms of profit split, they both offer 90-10. In terms of minimum trading days, Topstep has a 2-day minimum because of the 50% consistency rule. Therefore, you can't pass an evaluation in less than 2 days. Apex is usually 7 days. However, again, with their promotions, they usually have a 1 day to pass. In terms of trading style, Topstep is more conservative and more consistency focused, while in Apex, it allows for more flexibility and more aggressive trading. In terms of payouts, Topstep has weekly payouts and Apex has bi-monthly payout periods. The last thing left to understand is how taking payouts works on both Topstep and Apex. Let's explore payouts and the rules surrounding them between Topstep and Apex. So Topstep has two options: the 5 winning days of $200 or more, or the 30 winning days of $200 or more. So 5 non-consecutive days of net P&L $200 or more gives you your first available payout, and you're eligible to withdraw 50% of your account balance per payout request with a minimum payout of $125. If you have 30 non-consecutive days of net P&L $200 or more, you're eligible to withdraw 100% of the account balance anytime with a minimum payout request of $125. In Apex, payouts are limited to $2,000 twice a month for the first 3 months per account. After the first 3 months, you can withdraw any amount bi-monthly. However, there are some rules which one must adhere to in order to ensure that payouts are not denied. The rules are the following. The 30% consistency rule. The 30% rule stipulates that when traders request a withdrawal, no more than 30% of the profit balance in your account should come from a single trading day, counting from the first day of the funded account. The 30% rule will no longer apply after your 4th month of withdrawals. DCAing, dollar cost averaging. Dollar cost averaging is defined as a practice of entering a trade with a directional bias and the market goes against you in the other direction, but you continue to enter more and more orders in the direction of the original order, even whilst the market continues to go the opposing way. Apex will only allow traders to DCA once per trade. On the flip side of that, Apex will allow you to scale into winning trades only within reason. Apex also wants to see contract size consistency. If you trade with 3 to 5 contracts on average, what they want you to be is consistent with your size. They don't want to see trades taken with an abnormal size in an attempt to obtain a windfall trade. News trading is strictly prohibited. And the 1 to 3 target rules. So what does this mean? This means that going for very small ticks in profit, but using large stop loss, i.e., rule of thumb, to make $100 in profit, your stop loss should not exceed $300. To recap, I want to go over the pros and the cons of funded accounts. The pros: they give you leverage without risking personal capital, and traders can manage larger accounts without needing personal funds. They provide profit opportunities. The profit sharing model allows traders to keep the majority of their earnings. They provide access to coaching and resourcing, so some prop firms offer educational support and training for traders, particularly those just starting out. The cons: the fees. Traders must pay for the evaluation, which can become costly if you don't initially pass. The strict rules. Risk management and drawdown limits are strict, and violating these can result in losing the account, even if the trader is otherwise profitable. Profit sharing. While a portion of the profits goes to the trader, a percentage also goes to the firm, which may be higher than if the trader were trading on their own capital. So to summarize, prop firms provide a valuable opportunity for traders who have the skills but not the capital to trade on a larger scale. Firms like Apex and Topstep offer different paths to funding, each with its own advantages depending on the trader's style, risk tolerance, and desire for flexibility or structure. For those entering the world of proprietary trading, understanding the differences between these platforms can help in selecting the one that aligns with their trading goals and preferences.